When you were 25, if you had $30,000 in your super fund and you didn't put another cent in, and it increased by 8% per annum, by the time you were 55, that would be more than $3 million.
And reports today the Treasurer is seeking to expand his already contentious tax hike without parliamentary approval. Now, this is really interesting in legislative drafting terms because he wants to use a little-known clause known as the Henry VIII clause. Constitutional law expert Greg Craven has unpacked all of this today. He says it'll allow the Treasurer to adjust key parts of the plan once he sees how much money it's bringing in.
To increase taxes on Australians without any checks and balances going through Parliament. It really is quite extraordinary, and I think that Australians, and as you say, taxpayers in particular, are right to be alarmed by this.
Within the next 30 years, 8.1 million, or more than half of the working population, will be over that $3 million mark. So without indexation, eventually every worker will be paying tax on unrealised gains, so they'll be paying tax on a profit that may never eventuate.
So you don't have enough taxpayers in this nation to support the needs and the requirements for government. So it's a massive shortfall. Yeah, look, it's certainly attracted a lot of attention in the last couple of weeks, and just bear in mind that the date we believe we've been told is the 22nd before that gets passed. If it gets passed, which we think it will, on the 22nd of July, and then that'll be effective from the 1st July this year. Look, in the last probably 2 or 3 weeks, last month, I've spoken to people that are affected by the change, and I think that rather than everyone have a knee-jerk reaction to jumping out of super, I think the threat for me is, the threat for people, and the concern is the different taxes. Be aware of what we've paid to get the money into super. And if you take a $3 million client that has that amount in super now, and keep in mind, it's not so much as in super, it's per member. So if you've got a self-managed super fund and you've got a wife or spouse and 2 children under the super fund, it's $3 million per member, not the super fund itself. That needs to be put into perspective. So adding parties to the self-managed super fund, you'll probably see more of that, and where it's eligible, where in such situations where business people can put money in to their children, whether they're in business or not, and so there's structures there. But what's important to understand is, I think, is when someone's accumulated that amount of money, or any amount of money for that matter, they've paid income tax. So if someone out there is on $100,000, $150,000, they've effectively, depending on their marginal rate, they've paid between $38,000 and $45,000 of income tax to the government. Period. Right? That's income tax, and then they've put contributions into super, and that money has been taxed at 15% on earnings. So the earnings has been taxed. And I think, and everyone's accepted that for the last 20 years. I think the biggest concern now is obviously, why should we be penalised, as we mentioned last time, on the trigger? And so analysing it all now, assuming it does go through, is that most of the accountants, senior high net worth advisors, really focusing on now, preparing for, we think, a blend of family trusts and discretionary trusts with corporate beneficiaries and superannuation as a blend will be what we see the landscape going forward. And I say that because it's not that the superannuation, and a calculation we did just yesterday on an example, it was a client that had $3 million and had a capital gain of $100,000, and the unrealised gains tax was $487. And so on top of the 15% on earnings. So when you look at that, it's not a lot of money at that level. Last week or the week before, some weeks back, we spoke about Charles Gibbons with a $1.7 billion super fund, a $25 million tax bill per year. That's an extreme case. But I think things, the biggest concern was not the tax on earnings, it was the non-realised and non-trigger event, people being penalised on that. Well, I think if they're over the 3 million, I mean, the first thing you would say is that, well, is there anything, you're looking at a comparable instrument or structure that you would be better off to move to if that is super. So I think that it's a case by case, and what I'm finding is the cases that I'm dealing with significant amounts of money in super, way beyond $3 million, and they're eligible to withdraw money, and so that is going to turn into an expense to the super fund on unrealised gains, and they are sophisticated investors, professional investors, not sophisticated professional investors, which is another level above, and they're they'll make withdrawals, and that money will go into a myriad of different trust structures that will be available to them, and that will include their spouse and their children and other beneficiaries. So I think you're going to see a combination of that. But up until 3 million, you'd be hard pressed to go and find something that's taxed in a concessional way as that the superannuation is. So I don't believe that at the moment that up until 3 million, superannuation is still a pretty good deal. I think we've emphasised that before. The only area of caution with me is that what else do they touch in relation to unrealised gains? It's been a bit of a shock, and a lot of trust, I think, has been lost with the average taxpayer. I think you'll see more self-managed super fund structures once they get up to that level. Keeping in mind though that the data from the tax office, there's just under 81,000 people that will be affected. Out of those, there will be 64% of those actually are self-directed and have a self-managed super fund. So the balance of those people will probably consider that. And I think the changes will be triggered from when there's a financial impact. Trusts will come into vogue, I think more so, back in vogue, and I think that that will happen triggered by events. Keeping in mind that the way the tax office is going to police this, it's going to be based on from what we're told, it's not a quarterly assessment at this point, it's a yearly assessment on the tax return. So the assessment will be done on the 30th of June each financial year to actually correctly calculate what the obligations are to the tax office. So I think and that's probably the only way to assess it. That's the only thing. And I think people in the asset allocation, which is another discussion, is that, when you're in a growth phase, you don't need the income. So you're actually investing into stocks. The dividend's not important to a large extent. It's the capital growth or growth companies, growth investments. And when people get to retirement, they're looking at more at income generated investments. So in this case, the unrealised gains is you're caught with no matter what, any improvement, whether it be by income or growth, is impacted under the unrealised gains. So it's generally speaking, trusts, family trusts, with a combination of super. I'm not advocating that super's dead, it's not, but I think anyone out there today that's concerned about it should seek professional tax advice, coupled with financial planning advice when they are drawing near to that level. We've been approached by quite a few people about that, and again, we've had people from all walks of life that have done extremely well in business, and they've been here all their lives, and they're now looking at asking us about the opportunities in the United States, which we have interests, and Singapore and nations like that. I believe and the answer to that is that there are certain individuals that, with speaking with their accountants, us being involved in consulting the firms, that it's been warranted. Some individuals have, there'll be some benefits on setting up an office in Singapore and having a family office, if you like, or an office over there. In Singapore, there's other considerations to also think through too, is that where they're going to live. So government's pretty stern on that. How long you've got to be in the country? Are you a citizen of XYZ? Are you still living in Australia? It means that the tax will be, if the money is derived in the investments are actually made in Australia, you'll be taxed at Australian marginal rates, tax rates. So it's a bit more complicated. Yes, but I've found that if you percentile the amount of people I've seen in the last, say, 6 months, we've found that, knowing this is coming at this level, that 25% are now not just considering, have taken actions to move offshore. I've always believed there's not enough talent in government. I've seen far more talent in the areas, in my experience in corporate life, than I have seen in government. The people are just not qualified. And I'm saying that when they whiteboard these theories they come up with, I've always been fascinated that no one has asked them who come up with that. What individual came up with unrealised gains? Who are these people and what are their names? And it's been a group of people, and they've all started to drink the same Kool-Aid. The answer to your question is that when you've got a nation that's got a war chest of $4.2 trillion, and there's been massive tax concessions on that money from the government. If you zoom out, if I'm running the nation, I look at that, and that's costing us $52 billion a year, because the individual has tax concessions on the way in, has tax concessions on when it's in, like say pre, during and post, and tax-free on the way out. So I look at that from an accounting point of view, and I say, well, look, we're losing $52 billion there because of the superannuation system. But the intention was to create a national savings system for people to be financially independent, hopefully, to take the burden away from the government social security. So you can't have, everyone wants to go to heaven, no one wants to die. And I think that, that was the design, but they've just conveniently forgot about that. We need more money to function, for the infrastructure, the roads and whatever the case. They've seemed to be short-sighted and not thinking about the social security obligations. Now that's going to come back and bite them. And now what they're doing is taxing the people that are on the bus or that have done the hard work, and low-hanging fruit, we've got them, they're in super. And from state perspective, we've got the people that have bought property. And so let's land tax that, because that's low-hanging fruit. So they've really approached and come after the wealth, and property is the backbone of the economy. And so it's the cost base, or the tax base, is only 15.9 million in Australia. So you don't have enough taxpayers in this nation to support the needs and the requirements for government. So it's a massive shortfall. And and that's why we're holding so much debt. So if the common thread of all this comes back to lack of production. Productivity is 20% of what this country was producing 30 years ago. That's the real key, is the productivity is, you've got a V12 potential output of 800 brake horsepower, but we're running on 2 cylinders. And so there's just not enough. And now they're taxing the people that have done the hard work. And that's why people have got their backs up.